Disney earnings are in focus after the company pared its losses in its really important streaming business. Let's bring in Disney's CFO, Hugh Johnson. Hugh, good to see you. It has been a while. Welcome back to Yahoo Finance. Let's start on that streaming business. The company pared its losses, the operating losses, to $18 million compared to $659 million last year. I guess one of the biggest questions investors are probably wondering, is that sustainable?
Yeah, good morning, Brian. We think it is. We feel terrific about the progress we've made on streaming. Obviously, we focused on both the cost side and the revenue side, and both are delivering. The streaming business grew 12% in the quarter, which is obviously a nice, healthy number for us. In addition to that, we're managing our spending much more efficiently. So we will go negative in Q3 a little bit more based on the timing of some cricket rights. But as we've indicated before, we'll be profitable in Q4, and we expect to build on that in 2025.
Yeah, it looks like you had a good, successful quarter, Hugh, in Disney Plus subscriptions. Now, that comes after Disney Plus took price hikes, in the fall of last year. Just given that momentum, do you think you have more room to push prices?
Yeah, we think we do. I think you're going to see prices steadily go up over time in the streaming service, mostly because the content we have is worth paying for. So obviously we generate a lot of our own IP, both on the television series side as well as on the movie side. And in addition to that, as we continue to build out the streaming service, in particular, putting an ESPN tile on later this year, and then adding ESPN Flagship as an option next year, we think there's just going to be more and more value there for consumers, and they'll be willing to pay more for it.
On the streaming business, Hulu subscriptions only up 1%. Now, you're trying to, I guess you're working with advisors. You have come up with a valuation on what Hulu, that remaining stake, is worth. Comcast has its valuation. Do you even need Hulu as part of the portfolio? 1% growth, it's not mind-blowing to pay maybe potentially $28 billion for the rest of this asset.
So I'm not going to say much about a negotiation that I'm in the middle of. I've got a pretty good discipline about talking about deals after they're done and not before they're done. That said, we already own 2/3 of Hulu, so it's already largely a business that we are in control of. We'll see where the negotiation goes from here, but we're continuing to work our way through that.
Fair enough. On the linear operation, help investors understand this asset. So the sales were down, the profits were down. What do the next few years look like for this asset, and what do you have to do to improve operating profits?
Well, I think it's important to think about entertainment in totality rather than thinking about the individual parts, because essentially it's the same consumer. They're shifting from one distribution channel to another distribution channel. So as we see growth in streaming, obviously those are the eyeballs that oftentimes previously were in the linear business. I tend to look at it more in aggregate. And as I look at it in aggregate, I think we've got a business that's got the potential for good, healthy top line. And over time, will actually increase margins on the streaming side as the linear side continues to erode a bit. That said, I do suspect we're going to hit a point where the linear business will start to level off, because people do choose to leave for certain reasons, and for a lot of people, they choose to stay. Eventually, we'll hit the point where it's just the stayers that will be there.
Is the business still being reviewed for further cost cuts?
Yeah, I mean, any time a business is losing revenue, you have to look at it for cost cuts. And I think the team is doing a terrific job trying to come up with creative ways to produce television programs more cheaply, share resources where it makes sense, take a hard look at really every dollar that's being spent and say, okay, is this one that's necessary, or are we better served cutting that dollar and putting it elsewhere in the business so that we can continue to drive growth as an overall company?
I'm sure you're watching, you and the team, Hugh, on what's going on, the drama around Paramount. Wherever that asset ends up, how does it impact your linear networks?
I'm not sure it's going to make much of an impact on us, to be honest with you. I know they've got a lot of sorting out to do over there, so we're not really a part of it. So I couldn't tell you where I think it's going to go, but we're sort of focused on making sure we deliver the best content to consumers with our business, and then we'll let the chips fall where they may.
Big quarter from the parks business, Hugh, especially international. What are you seeing there?
Yeah, the growth has been terrific in parks. 10% revenue, 12% OI, and the parks specifically component of it actually grew OI 13%. International continues to lead the way for us, and it's very broad-based. All the parks are making money now. We're seeing very strong business in Paris, very strong business in Shanghai. In addition to that, the Hong Kong business is doing well. And the business in Tokyo has been quite strong. So feel very, very good about those businesses. And candidly, I think we've got lots and lots of potential future growth in parks on the international side.
I'm one day into the Milken conference, Hugh. That's why I'm doing this interview. And lots of chatter, I think, on signs of a U.S. economic slowdown. Of course, we had some problems or slowdown in the recent GDP print. Are you seeing any signs of a slowdown in summer bookings at Disney?
We haven't seen any of that at this point, so we certainly feel good about that. Now, as I understand it, the lower income consumers, sort of in the lower deciles, are the ones that are feeling the pinch a little bit more. But even for those consumers, the family vacation is one that's kind of a priority for people. So when they're making decisions around what to cut, we typically get cut a little bit later than most. So still feeling good optimism about travel in the U.S. and in particular feeling good optimism about people coming to our parks.
Before you came to the company, Hugh, as CFO, there was a target put out there on CapEx investing in the parks business. Really, it was a mind-blowing number, $60 billion over 10 years. Now, the CapEx increased slightly in the most recent quarter in the parks business. Are you still committed to that $60 billion number?
We are. That number is still very much intact. Now, keep in mind, that's not an incremental number. That's a total spend. On a normal basis, we probably would have spent somewhere in the $30 to $40 billion range anyway. The reason we're doing it is the parks business has so much in terms of growth opportunities. The returns on invested capital are terrific in that business. The margins, as you know, are in the mid to high 20s. So if you're going to invest, those are the types of businesses you want to invest in. And I think we're going to get terrific returns for shareholders out of those investments.
And lastly, Hugh, of course, this is the first quarter earnings being reported after the battle with activist Nelson Peltz. You battled this guy twice. Of course, at PepsiCo, now and coming here at Disney. What has this experience been like, and what is it like for a big company like Disney to go through this type of situation?
Well, candidly, it was a bit of a distraction for a couple of members of the senior team. That said, look, the management team under Bob is focused on creating value for all the shareholders, not just one or two of the ones that tend to be a little bit more talkative. And as long as we keep our eye on delivering value for all the shareholders, I think we'll be in a terrific spot going forward.
Well, Hugh, I didn't slip and almost ask you a PepsiCo gross margin question, so I'm proud of myself, and I am proud of you for not even bringing up the company. Hugh Johnson, always good to see you. Thank you for making time for Yahoo Finance. We appreciate it. We'll talk to you soon.
Disney's earnings, the company's stock moving to the downside after mixed results. So for more on Disney earnings and that share down a little over 8%, we're going to bring in Anthony Forcione, Rockland Trust Vice President and Portfolio Manager. He is also a Disney shareholder. Anthony, thank you so much for being here this morning. I want to start by asking you about Disney's pricing power, because I'm curious how much pricing power you think they still have, and whether to you you'd view this earnings print as defensive in terms of cost cutting or potentially offensive and showing you that there's more growth to come for this name.
Good morning. Thanks for having me. So in terms of pricing, they definitely have a lot more pricing power within their portfolio. Today's print certainly brought a little bit more exciting action than I would have imagined. I mean, when you look at the numbers, they were a very solid quarter, raised guidance for the year, reiterated their outlook on free cash flow and cost efficiencies. But at the end of the day, I think the market probably wanted a little bit more and was a little bit worried about sequential guidance in their theme parks, which when you take out the one-time costs are going to be completely in line. So when you look at pricing, they do have still power in their theme park, and then certainly within the DTC business as they continue to optimize that model.
So, Anthony, is this a buying opportunity then when you see the stock off 7.5%? Is this a reason then maybe to get in and position yourselves for those gains?
Yeah, I think when you take a wider lens, the longer term opportunity is still there. When you look at the DTC business, we've got a great view on this business. When you look at Netflix's business, while not exactly the same, certainly comparable enough to say this business is entitled and should get margins in the mid-teens or perhaps even higher as they continue to evolve the model internationally. And that equates to $3 billion plus of operating income and $2 plus in earnings power. And I don't think that's reflected in the stock yet. And I think what investors are also underestimating is this cash flow continues to compound. There's optionality in terms of returning capital to shareholders that's not reflected in the stock. So I think the risk reward is still good.
But when do you think we might get that capital returned to shareholders then?
Yeah, we're already seeing it. They repurchased a little over 1 billion shares this quarter. They instituted a dividend also recently. So that is happening. And I think will continue to happen as they continue to compound cash. And I think another strong element is that, it's been an unprecedented time in their studio production, and that should be a lot better going forward. That, continues to energize the flywheel they have.
And then we take a look at some of the headlines that came out of the earnings call here earlier this morning. They talked about the third quarter profit to be impacted by cruise costs, by inflation. They also went on to say that parks growth was, quote, moderating from peak post-COVID levels. When you take that into account, how big of a challenge of a headwind do you see inflation, if we do remain at these levels, stickier than many had forecasted to be at this point? How big of a headwind is that for Disney, at least in the short term?
Well, it's somewhat of a headwind for Disney as they're a consumer-facing company, and they talked about that with higher wage costs for their business. But ultimately, I think it falls back onto the pricing power they have. They provide a very, very unique experience to consumers. And when you think about the theme park business, again, looking at a wider lens, I have no concerns over this business over the longer term. It's a fantastic business. They're going to be putting a lot more capital into it over the next 10 years. Tremendous opportunities for expansion and invigoration in terms of new attractions. So I think this business is going to be much bigger over the next 10 years.
Well, I'm curious, too, about the streaming business, Anthony, because I know that there have been questions, especially to the CFO who we spoke with earlier, the Yahoo Finance team, about Hulu's valuation and any potential deal making surrounding it. Are you looking to hear more information about a potential deal, and would that make you more bullish on this stock?
Yeah, I think we are going to hear more news in the coming weeks and quarters, certainly on Hulu. They've got to decide on the right valuation, and I understand they're bringing in a third-party evaluator to do that. And I think that'll be settled shortly, and probably acts as sort of a near-term catalyst to sort of have that behind us. And that's a huge opportunity, and they talked about it in the quarter a little bit, how they've added the Hulu tile within Disney Plus, and that should increase engagement, lower churn, lower marketing costs, and then, ultimately continue to build value for the franchise.
And then when we talk about the longer term prospect here of Disney, we got to talk about succession, what exactly Disney is going to look like under Iger. What are you hoping to hear in the coming quarters, and how do you expect this to play out?
Yeah, it's a great question. We heard about it a little bit on the call today, how the board is obviously very focused on that's a succession planning. Ultimately, they're going to work with Mr. Iger and settle on when it's the right time for him to leave. But it's a really important decision for them, given the recent management changes that they had. So I think this is a really, really important point for the board to do this properly and correct, and take on this actually very difficult challenge of finding the next CEO of Walt Disney Company.
Anthony Forcione, we really appreciate you taking the time here joining us this morning. Rockland Trust Vice President and Portfolio Manager. Thanks.
Disney is out with earnings ahead of the open. The company's direct-to-consumer platforms, Disney Plus and Hulu, reached profitability for the first time ever. Does that mean that you might have to stop sharing your password with family and friends here because of some new crackdowns that could be on the way? Our own Alexandra Canal has more. Hey, Ali.
Hey, Brad. Unfortunately, it looks like that's the case. If you're a subscriber to Disney Plus, Hulu, or ESPN Plus, that password sharing crackdown is coming for your accounts. The company did confirm on the earnings call that a rollout on that crackdown is expected next month in select markets. We are going to see a wider global rollout start in September. And this comes as Disney is really looking to achieve sustained profitability. It was interesting on the earnings call, Bob Iger did reference Netflix, which is arguably its biggest streaming competitor, saying that they have done a great job with the password sharing crackdown. And you can see that in the results, as Netflix has been the only consistently profitable streaming service on the market. He said in part, quote, "We feel quite bullish about it. it. Obviously, we're heartened by the results that Netflix has delivered in their password sharing initiative and believe that it will be one of the contributors to growth. And that comes as, really right now we're seeing streaming hurdles across the board here. Yes, we did see Disney Plus and Hulu turn a profit for the first time ever in the quarter, but the company did warn that that's going to dip again in Q3. Overall, total direct-to-consumer losses, that is still it. We still have a loss here. We're not profitable there quite yet. Iger thinks that this password sharing crackdown can help us get there.
And then what about on the experiences side of this business? I mean, what are we picking up there about how the pricing may shift when we're going to the Magic Kingdom and perhaps it feels a little bit less magical because of how much we have to spend?
Right. Well, the company did note that inflation is pressuring its bottom line, especially when you think of those higher cruise ship costs, higher costs in the parks business overall, and that they're noticing a waning of demand when it comes to that peak COVID, post-COVID travel that we saw with a lot of consumers, right? Yeah. Many people were locked in their homes. They wanted to get out there. Now Disney is saying that's not necessarily the case anymore. We're seeing a bit of a pullback there, and that comes as prices have risen really across the board. So this is a very important narrative to really watch for a company like Disney, since consumers drive the bulk of their business. If they're not spending on the cruise lines, if they're not spending on the parks, and they're not attending, that's going to hit demand. So all things to start watching.
And the incremental purchases, if they're not paying up to skip the lines as well.
Exactly. Got to get those fast pass lines.
Exactly. Allie, thanks so much for taking the time breaking down all things House of Mouse.
Sticking with the media giant as Disney's turnaround efforts take shape and eyes profitability with its combined streaming business. Our next guest is feeling optimistic in the path forward for the company. Joining us to discuss is Robert Shine, Blanky Shine Wealth Management Chief Investment Officer and also a shareholder of Disney. So Robert, let's start there. Disney reports investors clearly disappointed, Robert, but you're a shareholder. So let's start with your response and reaction to the report, Robert.
Yeah, we believe if you look at market action today on Disney stock, it's overreact. So what that does is present an opportunity. If you're a long-term shareholder for Disney, you can average in year to date. We're still up significantly, especially since October lows. But moving forward, the quarter was solid ultimately, and that's what we're looking for. So we know that management is focused both on the top and bottom line. Narrow miss on the top line, bottom line, they made it. But moving forward, I think the biggest disappointment, why the movement is down today, is sort of the guidance wasn't what Wall Street was anticipating or looking for. So that was disappointing in the future guide.
And Robert, I'm curious to get your opinion on this because you voted for Nelson Peltz in that proxy fight battle that didn't come to fruition. Disney was able to successfully fend off Peltz. Does this earnings report give you the confidence that the current board has things handled, or because of the fact that we have that softer guidance and there seems to be some overhanging headwinds here, do you think that this board needs another person like Peltz? And do you anticipate more proxy battles and fights in the future?
At the same time, I do believe that last quarter's drama is behind sort of the Disney management team, but it's not out of the picture, right? It's that sort of villain that could potentially re-present itself, but not a villain in a bad way, in a great way, especially if you're a Disney shareholder. By that, I mean, you have management's focus on basically profitability. They're basically shareholder friendly right now. They're focused on quality sort of family content moving forward and executing on that. If you look at the entertainment pipeline for the back end of this year, it's solid. 2025 and 2026, all the sequels and all of the great new content, as well as the investment into the theme parks, over $60 billion. And don't forget, last quarter, they also announced 50% boost to their dividend, $3 billion buyback. So I wouldn't be surprised if they're out there doing that today. Obviously, the direct to consumer is the story where that became profitable, as well as in terms of the streaming. I think the streaming, as we've seen others in that world, has scalability. So again, Disney is in a category of one. There's really no competition if you look at what their library is, and they have $1 billion after $1 billion opportunity just to execute. They just have to keep focused on the financials, and they've already announced, $7 billion. They're on track to keep that $7 billion sort of cost-cutting initiative across the board. So by that, as long as they're focused on being shareholder friendly and minding sort of the highest and best uses of capital, but yeah, we have confidence moving forward.
You know, Robert, so Disney's CFO, Hugh Johnson, was on Yahoo Finance this morning. He talked about that bruising proxy fight. Let's take a listen.
It was a bit of a distraction for a couple of members of the senior team. That said, look, the management team under Bob is focused on creating value for all the shareholders, not just one or two of the ones that tend to be a little bit more talkative. And as long as we keep our eye on delivering value for all the shareholders, I think we'll be in a terrific spot going forward.
All right, so there's Hugh Johnson calling it a bit of a distraction there, Robert. I am curious, though, you know, as a shareholder, why you wanted Nelson Peltz on that board, Robert? Why you voted him? What were you kind of hoping he would bring? What levers did you think he was going to pull?
Either way, it was a win-win, right? He basically got management's attention. Whether he was physically in the room moving forward, he's mentally in the room moving forward. And really, again, they're in a category of one as it relates to what Disney has as a product and a service and an entertainment business. And then their wonderful storytelling, sort of, lifetime generational. They just have the ability to capture that moving forward. And I think they were just going in too many different directions. And now that they can focus on a sort of a keen focus on a great way, it doesn't mean that Nelson Peltz is not sort of in the wings. But, from, below $100, I always thought, Disney below 100 is a generational buy. Now you got that magic of opportunity being down 10% today. Moving forward, I believe wholeheartedly management's going to execute, and you're going to see, it's down 50% from its 52-week high. So there's a lot of shareholder value still to be realized. Management is not out of the woods. They still have a lot of work to do. And again, they're going to get called down to the principal's office, whether it's Nelson Peltz today or somebody else, in the shareholder world tomorrow, that basically believes that they could do a lot better. And the reality is they can, and that's why there's tremendous value. Both, it doesn't matter who you're voting for. Moving forward, there's value to be had.
So you would consider this stock decline today, we're set to close down nearly 10%, as a buying opportunity? Would you say that, and why?
Yeah, again, direct-to-consumer streaming was a very positive, unexpectedly, so that was better than expected. The cost cutting is still taking an effect, so that's helping all the numbers. The uncertainty component, and that's the one thing that we all have to see if it's just a story outside of Disney moving forward, is the consumer, right? They basically said, hey, listen, that's where everyone got spooked right now and say, oh, wait, consumer discretionary. Is it a kitchen table economic, personal to what's happening out there because the economy is so tough, inflation, so on and so forth. So does that become a bigger issue, i.e. impacting Disney's theme park, which is their biggest revenue source? So that is the concern that sort of Wall Street's looking towards right now. And then the CFO this morning basically said, hey, listen, I'm going to give you conservative guidance. Conservative guidance from a management team is always positive moving forward because they always want to manage expectations low and set the bar low so they have success moving forward. So.
All right, our thanks to Robert and Allie both for joining us today. Great chat. Thank you both.